Welcome to our webinar tonight. We are going to be talking about how to identify, explore, and identify markets when looking at multifamilies. So I am your host Jefferson, and then I'm with my co-host John Ortiz. Okay, so we'll kind of get right into it. So you guys can see my screen, right, John?
Yeah, you're good, Jeff.
Okay, perfect. So again, this is going to be exploring and identifying markets. So these are some of the tips and advices that we've been able to do to find our markets and find what markets to invest in, specifically when you're going out in the US, which is a bit of a different route than investing in Canada. So you just want to make sure you do a little due diligence. So we'll get started right away. So just share my table of contents here. So this is going to be the table of contents and what we're going to be talking about. So first, we're going to be doing introduction to the team, the importance of market selection, identifying emerging markets, analyzing established markets, our top 5 markets for multifamily investments in 2023, and the top 5 myths about investing outside of your backyard. And then we'll do a little bit Q&A and conclusion. So John can take it away.
Absolutely. So we'll do here a quick introduction of our team. Who is Ortiz Equity Group? We are a team of experienced real estate professionals who specialize in acquiring and managing multifamily properties in the U.S. We understand the challenging of investing in real estate, especially when you are short on time. That's why we offer a passive investment opportunity that allows you to invest and diversify your portfolio in multifamily properties without having to worry about the day-to-day management. What is our track record here? A team that has over 50 years of collective real estate experience, that has a track record of success across various industries ranging from hospitality to technology, government, small businesses, and finance. The track record between all of our team includes 17 deals completed to date, 7 full cycle deals completed from start to finish. Total amount of units under management is around 1,647. Assets under management, as far as dollars, it's 146 million. And in total transactions, 250 million plus. And some of the assets are located in North Carolina, South Carolina, Florida, Texas, Indiana, and Arizona.
Perfect. Thanks for that, John. And I just wanted to add to the units and pretty much everything. There was a recent deal that closed, so that number might have even changed, increased. I mean, from previously. Right,
That's correct. We got to update that.
Yeah. So the importance of market selection. So what exactly is market selection? So when you're investing in multifamily real estate, particularly what we focus on, which is 100 plus units, particularly 100 plus apartment complexes, can offer significant financial benefits and long-term wealth generation. However, the success of these investments heavily relies on selecting the right markets. Market selection plays a crucial role in determining the profitability, sustainability, and growth of potential multifamily investments. Here are a few key reasons why market selection is one of the utmost importance. So, first point that we're going to touch on is rental demand. The demand for rental housing varies across different markets. Choosing a market with a high and consistent rental demand ensures a stable cash flow and occupancy rate. Markets with growing populations, strong job markets, and limited housing supply tend to exhibit robust rental demand. So, again, we're talking about the US specifically. That is one of the most important things that you want to look at is what is the rental demand in that market. Not every market in the US is growing in population and has a lot of rental demand. You might have places like Detroit. You might have some other smaller cities that are not seeing high rental demand. Second point here is economic stability and growth. The economic health of a market significantly impacts the performance of a multifamily investments. Markets with diverse industries, strong employment opportunities, and stable economic growth provide a solid foundation for sustained rental demand and property appreciation. Understanding the economic indicators such as GDP, employment rates, and industry diversification is crucial. Now, what we want to add to this is that the economics are so important in the multifamily space, and the main reason for that is because this determines what tenants you're going to be having and where those tenants are going to be employed, which then determines how much vacancy and how much in concessions pretty much tenants not paying and so on. So this is a key. I would say this is probably the number one thing that we look at when we're looking at a market. What is the employment? What is the diversity between the different employers, the major employers? Is it only one industry? Like, for example, is it only car industry, or is there diverse, right? As you guys might have remembered from what happened in Michigan, you don't want to go, or Detroit, sorry, you don't want to go into one market that only has one major employer. You want to make sure that it has a diverse of employers. Now, market saturation and competition. Now, when assessing the level of market saturation and competition is vital. Entering an oversaturated market with intense competition can lead to challenges in achieving desirable rental rates and occupancy levels. Identifying markets with a favorable supply-demand balance and limited competition increases the chances of a higher rental income and property value appreciation. Now, a lot of us can relate to this. When Canada the market was super hot, there was no, I mean, even now the market is not as hot. It's almost impossible to find properties that cash flow and properties where you can still make the numbers make sense. In the US, there's a lot of markets, but there's so many markets that it's a lot easier to find those secondary, tertiary markets, and where you can still create a huge value add. Now, regulatory environment and local policies. Understanding the regulatory environment and local policies is essential for assessing the feasibility and profitability of multifamily investment. Local laws, zoning regulations, rent control measures, and other policies can significantly impact the ability to operate and generate returns on investments. Analyzing these factors helps mitigate potential risk and identify markets with favorable legal frameworks. We typically invest in red states. And what does it exactly mean for multifamily? Because we are investing in states and where we as the landlords have a lot of the control, and tenants essentially have to follow the rules or they get kicked out, or you can increase the rent. There's no rent control, so you can essentially increase the rents to what the market rents are. This is crucial for multifamily. And that's why we chose US, specifically the red states, because they give us a lot of control as the landlords. So then we're able to actually execute on our business plan, which tends to have some renovations and some price increase per unit or per building. So that's why this is such a crucial part of when analyzing a market. I know in Canada, there's Ontario, there's Alberta and Saskatchewan, and I think Alberta and Saskatchewan are a little more tenant friendly, but then the markets, the economics and other things don't really match. So that's why we didn't choose those markets, and we specifically focus in the US and specifically the red states, which are typically North Carolina, South Carolina, Tennessee, Arizona, Ohio, Indiana, Indianapolis, and so on. Now, growth potential and investment opportunities. When evaluating the growth potential of a market is crucial for long-term investment success. Markets with a strong growth indicators such as population expansion, infrastructure development, urban revitalization initiatives, and job market diversification offer attractive opportunities for multifamily investments. Identifying emerging markets in untapped regions with potential for future growth can result in a significant returns on investment. Now, with this one, when we are analyzing a market, one of the main things that we look at is what has the population done over the last 10 years? Has it been growing? Has it been declining? Or has it been steady? In all the markets that we are in, the population is growing. And one of the major factors of that, especially in the US, is that people are fleeing California, San Francisco, New York, LA, and they're going to the Sun Belt region and the Midwest because the rentals are cheaper, the taxes are cheaper, and the weather is better, and there's just more opportunities overall. So your money goes along a much longer way. So that's another factor there. Okay, John, go ahead.
Thanks, Jeff. And I just wanted to mention not just people, but also businesses. A lot of businesses are moving their headquarters, their distribution centers to the Sunbelt regions where, again, it's a lot cheaper to operate and have better margins and so on.
Yeah, and I anticipate that this will continue to go on for the next so on. The main reason for that is because New York, much like California, have been really increasing the tax and the cost of doing business. So for a lot of business owners, and we're not just talking business owners, we're talking Fortune 500 companies. It makes a lot more sense to relocate and save big bucks on taxes and be cheaper to operate. Go ahead, John.
Definition and characteristics of emerging markets. Emerging markets are referred to regions or cities that exhibit potential for economic growth, urban development and investment opportunities. These markets may be experiencing a significant influx of population, attracting business, and undergoing infrastructure improvements. Below, you'll find the criteria we use for identifying potential emerging markets for multifamily investments. Population growth and migration patterns. So this is something really interesting to look at, something that we look at heavily when we're underwriting to ensure that everything in the multifamily investment is something that we're moving forward with as far as the city and the pattern. So analyzing, can you go back, Jeff? There, thank you.
Sure.
Analyzing population growth rates and immigration patterns in specific markets. Look for markets like Market A, which has experienced a 15% growth in the last 5 years, or Market B, known for attracting large number of young professionals.
Sorry, my apologies. And I just realized that there was a mistake there. So we were actually in this particular case, we're actually talking about Charlotte, North Carolina. That's what it's supposed to say there. And then same thing and the Market B was just supposed to be Indianapolis. I just wanted to add to that. I realized I made a mistake on the power presentation. But go ahead, John.
Next slide, Jeff. Economic development and investment opportunities. So assess the economic development indicators of the potential markets. Consider factors such as, again, Charlie, with a 7% increase in GDP over the past 3 years, thriving industries, job creation, and business-friendly policies. Identify markets with significant investment opportunities, such as Charlotte, which has an attractive major corporate investment and development projects.
Yeah, and one of the things that we like to do is we like to call the city development for that specific market, and just get a little bit of an idea of what's going on over the next couple of years. What is some of the development? What are some of the new investment opportunities in terms of projects? What is the new, what's happening in each market, and where specifically in the market are these developments happening? So that way you can be ahead of the curve, and they'll be happy to say that to you and give you those answers, because they want you to invest in their market. They want you to after there.
Correct. And it's very, very data driven. That's what we love about the US. It's very data driven. So they have stats in each government website where you can see sources of population growth over growth, employment, vacancy rates, and it's just all driven by data. And it's something great that we love about the US, that they're data driven. Housing affordability and rental market dynamics. Evaluate the affordability of housing in the market. Look for areas where housing prices or rental rates are relatably affordable compared to nearby competitive markets. Study the rental market dynamics, including vacancy rates and rental demand. Market with low vacancy rates, increasing rental rates, or shortage of quality rental properties may indicate strong potential for multifamily.
Yeah, thanks for that, John. And something I wanted to add to this, and I know I'm touching on this quite a bit, but just to show you guys why we are so obsessed in the US as opposed to Canada. In Canada, there is a high demand for housing, but the challenge with it is that the government isn't really incentivizing investors to take over a property and increase the rents, because the rents, once you acquire an asset, you can't really get the market rents, the full market rents as you could in the States, because of the landlord rules that exist here. In order for you to essentially get a vacant unit, you have to, in most cases, do something called cash for keys, which you're essentially paying the tenant a big portion of money for them to vacate the unit. And a lot of times they won't actually accept the cash for keys. In a lot of cases, they're professional bad tenants, so they actually know the rules, and they'll stop paying until the time where they have to pay again, which is close to, I think before you get a tenant out and they're not paying, is 8 to 10 months in Canada. So, or in Ontario rather. So it's huge. It's huge. Go ahead, John.
Infrastructure and urban development initiatives. Examine the infrastructure and urban development initiatives in potential markets. Look for regions with significant investment in transportation, public amenities, and revitalization projects. Identify markets with urban development plans, such as, that's supposed to say Charlotte there, but anyways, million of infrastructure improvements and new public facilities. Conclusion: by considering this criteria and utilizing available data, passive investors can identify emerging markets with growth potential for multifamily Investments analyzing population growth, economic development, housing affordability, rental market dynamics, and infrastructure initiatives helps us as investors pinpoint markets where investing early can lead to significant returns in the future.
Thanks, John. Okay, so now we're going to be analyzing established markets, right? We determined the markets. Now we're going to analyze established markets. A definition and characteristics of established market. Established markets refer to regions or cities that have a history of stable real estate performance in a mature multifamily housing market. These markets are characterized by established infrastructure, a stable economy, and a track record of consistent rental demand. So we're going to be factors to consider when evaluating established markets for multifamily investment. We're going to be going over that now. So factors to consider when evaluating established markets for multifamily investment. First one is historical performance and market stability. So evaluate the historical performance of the market, including property appreciation rates and rental growth over the past decade. For example, in Columbus, Ohio, multifamily properties have experienced an average annual appreciation rate of 8% over the past 10 years. Now consider markets that have demonstrated stability even during economic downturns or market fluctuations. And especially during COVID and even 2008, one of the markets or one of the vehicles that got less hit is actually in the multifamily space, whereas the single family and stocks and all the other things crashed. Multifamily did take a bit of a dive, but then they've dove right back in. So it's just in the market, it determines a lot, right? If you only have C and D classes, which are kind of your lower type of class of properties you can have in a market like Detroit, or a market where it's a one horseshoe town, when the market crashes or it corrects, they get hit a lot harder because they're so dependent on that one industry. Second point here we have is capitalization rates and investment potential. We typically evaluate the capitalization rates, cap rates in the market. Cap rates provide insights into potential return on investment by comparing property income to property value. We look for markets with attractive cap rates that align with our investment goals and risk tolerance. So just to give you an example. Typically in Toronto, Mississauga, some of these other higher dense markets, the cap rate tends to be between 2 to 3%. Now, markets in that we are in are typically between 6 to 7%. So that right there shows you the difference in investments that the folks are going to have, right? If you invest and your cap rate is 2%, that essentially is what your return on, that's what your property income to property value is. Number 3, jobs and employment. I know we touched on this, but we just want to highlight the importance of jobs and employment in a market. It is the most important. If you guys take anything away, understand that jobs and employment are the number one most important thing in determining a market. Jobs and employment. Jobs are utmost importance when analyzing a market for multifamily real estate investments. The employment landscape directly impacts the tenant's ability to pay rent and sustain occupancy in multifamily properties. A strong job market with diverse employment opportunities increases the likelihood of consistent rental income and reduced vacancy rates. Conversely, a weak job market can lead to a higher vacancy rates and potential challenges in rent collection. Therefore, considering the stability and growth of potential of the job market is crucial when evaluating a market for multifamily investment, as it directly affects the demand and financial viability of the properties. And again, just super, super, super important. There is a strong employment and there's a lot of jobs, so that the tenants can always have somewhere they can always pay the rent, and you're not going to have a lot of issues with vacancies and collecting rents. Now, these are our top 5 best markets for multifamily in 2023. And John, you can take it away.
Thanks, Jeff.
Number 5.
Number 5 is Indianapolis. Indianapolis, stable growth economy, diversified economy, political environment, and it has a great multifamily fundamentals when you run it across the board on all aspects. And here we have a bit of a chart for you to see some of the industries that are here with current jobs and the growth and a 10-year historical percentage. So we've got government, information, professional and business services, educational and health services, retail trade, financial activity, manufacturing, as well as employment rate percentage. So you can see there the growth spike between 2019 and 2021. So just a huge spike there on employment and growth in infrastructure growing in the submarkets of the state of Indiana.
And just to look at that, the total employment number, can you say that, John? The current jobs?
The 1074K?
Yeah.
Yes, correct.
We'll
Yeah.
highlight, like, that's a massive number. And then the unemployment rate chart, John.
The unemployment rate, the one below?
Yeah, as you can,
Yeah. I just literally went over that one.
Okay, perfect. So yeah, so Indianapolis is number 5 for our top 5 markets for investing in multifamily. Indiana is a great market. It's growing. I mean, it's so much potential, and the numbers still make sense, which is unlike many markets. Number 4, John.
Here we've got famous Nashville, Tennessee. Population growth. Nashville has experienced a rapid population growth, consistently ranking among the fastest growing cities in the U.S. The population influx creates strong demand for housing, including multifamily properties. Job market in Nashville boosts in diverse and thriving job market across various sectors such as healthcare, technology, finance, and entertainment. It's home to its numerous major employees and has a low employment rate, indicating the stable and robust economy. Rental market strength. The rental market in Nashville is robust with a high occupancy rates and steady rental income growth. The city is vibrant with music and entertainment scene along with its status and as a regional economic hub contribute to the sustained demand for rental growth. So as you guys know, Nashville is the number 1 city for bachelorette and parties and weddings and all that stuff. So that creates a lot of demand, jobs and all that good stuff. So investing in Nashville and even in submarket cities where the main traffic is in Nashville, Tennessee, there you just have so many more options as far as investment goes. Tourism and hospitality industry. Nashville is popular for its tourist destination, attracting millions of visitors each year. The city's vibrant music venues, cultural attractions, and events create opportunities for short-term rentals and investment in multifamily properties catering to tourists.
Yeah,
So,
and I think if
sorry,
I'm
go
not
ahead.
mistaken, and I was going to add, and if I'm not mistaken, I believe Nashville is, if not one, I think one of the top 5 best markets for Airbnb. So that right there tells you the amount of tourism and the demand for tourism that this market has attracted over the last little bit, and it's just become really popular over the last couple of years. So that is going to even increase over the time. So that's so go ahead, John. Just I don't want to cut you off. Just wanted to add.
Development opportunities. Nashville has seen significant urban development and revitalization initiatives, creating opportunities for new construction and redevelopment projects. This offers potential for passive investors to participate in the city's growth and capitalize on favorable market conditions. It is also favorable to business environment. Tennessee has a business-friendly environment with no state income tax. So these are some of the things you've got to learn and read on each state, because each state in the U.S. is like its own little country, and attracting businesses and fostering economic growth. This favorable business climate contributes to job creation, investment, and stable real estate market.
Perfect. So that is number 4, beautiful Nashville. We were pretty close to getting a property under contract down in Nashville, 70 some unit building. And we love the market. Fortunately, it didn't end up working out. The numbers didn't end up working out, but we were really close, and we're looking forward to continue building a relation with brokers and building the portfolio that way. So Nashville is coming in at number 4. Number 3.
Number 3, we've got famous Atlanta, Georgia. Population growth in Atlanta has experienced significant population growth, consistently ranking among the top cities for population increase in the U.S. This growth fuels housing demand, making it attractive for market for multifamily investments. Number 2, employment opportunities. Atlanta boosts a diverse and thriving economy with major industries, including technology, finance, healthcare, and logistics. The city is among numerous Fortune 500 companies, providing a stable market and attracting a skilled workforce. Also to mention, Atlanta has the busiest airport in the world when it comes to volume per year. So that's right there. It tells you some really good stuff about the Atlanta market.
And we learned something about they have the most actors or the most something in
Yeah,
the.
the most actors and movie stars live in Atlanta, Georgia. For I think it's famous for filming scenes or
Yeah.
something like that.
Okay.
Um, Atlanta's uh, rental market remains strong with steady occupancy rates and rental income growth. The city's population growth, along with its role as a regional business and cultural hub, contributes to sustained demand for rental properties. Development and infrastructure. Atlanta has seen substantial development and infrastructure improvements, including urban revitalization projects and transportation enhancements. These factors contribute to the city's growth potential and present opportunities for multifamily investments. Proximity and to Hartsfield-Jackson Atlanta International Airport is one of the busiest airports globally. The airport enhances Atlanta's appeal for both business and leisure travelers. It increases the potential for short-term rental and investment in multifamily properties, catering to the travel industry.
Yeah, and I just wanted to add, we actually were just working on a deal out in Decatur, Atlanta, Georgia, MSA, and we are beyond excited to continuously look in that market. So we're going to continuously, we're actually working on three deals right now in the Atlanta MSA. So we really love Atlanta. We love the proximity to some of the other markets like North Carolina, South Carolina, Florida. I mean, Atlanta has just seen a tremendous growth, and I think it'll continue to happen just because of the proximity to Florida and North Carolina and some of these other markets. So Atlanta is definitely in our radar, and we'll be bringing in a lot of opportunities within this market, NSA. So we're tremendously excited. Number two. Okay, guys, we're getting closer to number one. John, go ahead.
Number two is Columbus, Ohio. Population growth in Columbus, Ohio has experienced significant population growth with an increase over 12% from 2010 to 2020. According to the U.S. Bureau, this has indicated a strong demand for housing, including multifamily properties. Job market strength in Columbus has thriving job market with an unemployment rate consistently lower than the national average, which is amazing news. The city has a growth rate of over 10%. A total non-farm employment from 2010 to 2021, according to the Bureau of Labor Statistics. This employment stability drives demand for rental properties and provides a reliable tenant base. The rental market stability in Ohio, especially in Columbus, has demonstrated stability with a relatively low vacancy rate of average around 4% in recent years, according to the market reports. This indicates steady demand for rental units and a favorable environment for multifamily investments. It is famous for its educational hub. Columbus is home to the state of Ohio University, one of the largest universities in the country. The presence of a substantial student population of over 60,000 students creates consistent demand for student housing, making it attractive and niche market for multifamily investors. Economic diversity. Columbus has a diverse economy encompassing industries such as healthcare, finance, education, technology, and manufacturing. The city is headquarters for several Fortune 500 companies and has significant increase in high-tech jobs in recent years. This economic diversity supports a stable job market and contributes to the demand for multifamily properties. The cost of living advantages. So this is another factor that we look at when we're doing market analysis is the cost of living and the household income per neighborhood as it changes all across the board in the US is completely crazy. Columbus offers a lower cost of living compared to many other cities, making it affordable options for residents. The affordability factor contributes to sustained demand for rental properties and markets in Columbus and appealing markets for passive investors.
Yeah, I absolutely love Columbus, Ohio. Like that's why we have it as number two, one of our most recent markets, to be completely honest. But one of the ones that we're the mostly excited about because the numbers make a lot of sense. Like as you've seen, it's a very diverse industry, and whereas at the moment right now we're working on a deal out in Columbus that it's how much is that? 70 plus 40, what is that? 120 units in Columbus, Ohio. You guys wouldn't believe what the price per unit is and the opportunity behind it. So it is by far one of our favorite markets, and we're going to continue to usually look for deals in this market. And we are very excited to be able to bring some exciting opportunities in Columbus. Drum roll. And for number one, we have number one.
Here, Charlotte, North Carolina. It is a beautiful city with lots of export industry jobs and business firms that are located in North Carolina. So just to get a started here, population search in Charlotte has experienced remarkable population growth with an increase of over 20% from 2010 to 2020. According to the U.S. Bureau, this search translates to a high demand for housing, presenting excellent opportunities for multifamily investments. The thriving job market in Charlotte boosts a robust job market driven by sectors like finance, healthcare, technology, and manufacturing. It has seen a remarkable 25% increase in total non-farm employment from 2010 to 2021. As reported by the Bureau of Labor Statistics, this job market strength ensures a stable tenant base and rental demand. So amazing tenants all across the board. Lots of professionals that live in this area that drive the city. Strong rental market. Charlotte's rental market remains robust with a consistent lower vacancy rates, averaging around 5%. According to the market reports, this stability signifies a favorable environment for multifamily investments, providing a steady rental income for potential long-term growth. The economic momentum in Charlotte is a major economic hub, attracting businesses and fostering growth. It is home to numerous Fortune 500 companies and has significant investments in infrastructure and urban development initiatives. These factors contribute to the city's economic momentum and create a conducive environment for multifamily investments.
Yeah, Charlotte is a phenomenal market, and I put Charlotte MSA because it's not just Charlotte. There's also some other markets within that MSA, like Greensboro. There's Winston-Salem. There is Fayetteville. So there's a lot of sub markets and outside of bigger cities as well. But Charlotte, in particular, in that MSA, has just the North Carolinas have seen a tremendous growth. And in Charlotte specifically, I believe, if I'm not mistaken, they're top 5 best market in the US across the board. So across any other market, I think Charlotte, if I'm not mistaken, they're number 3 or number 3 or number 2. But they were number 1 for business, like business employment and business in general, in multifamily across the board last year. So it is a phenomenal market. We have plans at Ortiz Equity. We have plans to relocate our office and ourselves to the Charlotte MSA and be able to do a little bit more asset management and find deals as well. So that is part of the reasons why it's number 1 in our list. We are planning to relocate to Charlotte. So we will be in the market over the next year and a half to 2 years. So that's one of the reasons why we're so excited to move there, relocate. And it's also one of the best places to raise a family is the Charlotte and Raleigh area. So just a phenomenal market. And again, guys, these are just our top 5 markets. Not to say those are the best markets for everybody, but it's our top, and these are the reasons why these are the top, our top. We did a lot of homework, and we looked at a lot of deals, a lot of data, a lot of different numbers to conclude to this list. So yeah, I mean, if you want to take our list and make it your own, then by all means. But we're excited to be bringing some exciting opportunities in these markets. And we wanted to create this presentation to be able to educate people on why these markets are so exciting and why we're excited about these markets more than anything. So we'll go ahead to the next part here. So this is a part of what we do in every webinar, and where we do our top 5 myths about the specific subject we're talking about. In this case, being our top 5 myths about investing outside of your backyard. And in our case, and I think in many of our listeners' case, is not just our backyard, but it's investing outside of your country. But I mean, the US is just right there, right? So it's not far. So top myth number 1, investing outside of my backyard is too risky without direct involvement. Now, the fact is, as a passive investor, you can rely on our team's expertise and knowledge. We handle the research, analysis, and risk management, allowing you to benefit from investing in different markets while trusted in our expertise. And by investing as a passive investor, it really does allow you to not be limited to a specific market or a specific country. In our case, we have partners across the board in all these markets that we are investing in. So you're able to leverage us, and you're able to leverage our partners who are already in the market. So it gives you a broader range of different markets in which you can invest in, which is really good to have. especially in a market like we have it in today's market where things are changing by the day and every market is so different. Myth number two, I won't have control over my investment if I'm not actively managing it. The fact is, by investing with us, you maintain control while we handle the day-to-day management. We keep you informed and involved in decision making, so you have control without the burden of hands-on management. And I think when talking to a lot of investors that have been in the industry for a while, one of the things that they talk is that they don't have a lot of time to manage rental properties, deal with tenants, deal with renovations. I mean, there's a lot of different things going on, and we actually we do this as a full-time job. So this is not a part-time job. This is not a gig. This is our full-time job. This is what we do. And this is what we spend our whole every day on. So this is our main focus. Something you want to add, John?
Sorry, Jeff?
Did you want to add something? I thought you were going to say something.
No.
Okay. Myth number three. I won't have a good understanding of the local market and dynamics and trends. The fact is, we have deep knowledge and experience in the markets we invest in. We do a thorough research and provide insights, ensuring you make informed investment decisions based on our understanding. And I believe, if I'm not mistaken, John, in every single presentation that we have completed with our investors, we spend a lot of time on employment stats, population growth, and so on, when we are presenting deals to our investors, because we understand that there might be some limited beliefs about investing outside of Canada, but that's what we want to educate. And these is part of the reason why we're having these webinars, is to really educate folks and let them know why we're so excited about the US, some benefits, and just teach folks along the journey. Myth number four, investing outside of my local area requires a significant capital and resources. The fact is, you can access diverse markets without a large investment. By pooling resources with other investors and leveraging our network, you gain exposure to attractive opportunities while sharing costs and benefiting from our expertise. Now, typically, when you're going to acquire an asset, let's just call it a fourplex, and you're going to invest, let's say, in Canada or in Ontario, wherever you are, right? If you're going to buy a fourplex, you're typically going to be putting about 20% down, which typically will work out to be over 100,000, and then you're going to have to spend another probably 70 to 100,000 in renovations. So all in, you're at a 200,000 to renovate. Typically, our projects, you can invest with as little, I mean, every project's different, right? But with as little as $70,000 USD, which comes out to be, I think, over a little bit over 100,000 Canadian. So you don't need a ton of capital, and this money you typically, for the most part, we will 2x the money in 3 to 5 years, while you receive consistent cash flow. Typically, like again, it ranges, but it's between 7 to 10% cash on cash. So you get to make money while you wait for your money to double. So it's the best of both worlds, right? Now, the beauty of syndication and what we do is that you can do it passively, and you can have access to deals where you otherwise wouldn't have access to, because we're talking about 100 plus units, 10, 20, $30 million deals, and you're able to be part of that larger deal, in which in many cases you were not able to access those deals. Myth number five, I won't have direct involvement in the day-to-day management of the properties. So the fact is, as a passive investor, you're relieved of management responsibilities. Our team handles operations, tenant relations, and maintenance, keeping you updated on your investment performance. Now, I just wanted to share a little story here, John, with everybody. I thought the same thing, that I wanted to be active. I didn't want to be a property man. I didn't want to deal with property managers. I want to be, how hard is it to handle a property? I can tell you firsthand that if you choose the wrong tenant, specifically in Ontario, Canada, you will have a lot of headaches. You will get a lot of gray hairs, and you might even lose some hair along the way. Because if you choose a bad tenant, for example, we chose a bad tenant for one of our rental properties, and it took us close to a year before we were able to get her out. She caused trouble to other tenants in the building, and she also damaged the building and cost us over $10,000, even though it was just freshly renovated and freshly updated. So that shows you that managing properties, managing tenants, getting new tenants, doing due diligence on tenants, it's a lot of day-to-day, not only that, but then you have to acquire the asset, you have to do due diligence. There's a lot of moving pieces, and nothing better than being a passive investor, not having to deal with that, and instead rely on the team that has a track record, like we showed you guys in the first picture. So that's another myth that we have, and I just wanted to share a little story with everybody. Okay, so we're gonna open it up for questions. So if any folks here in the chat have any questions, you guys can unmute yourself or you can raise your hand using the emoji there. If there isn't any questions from anybody, we'll move into the next one. I'll give it a minute or so. If you guys have any questions, just unmute yourself and just ask the question and we'll be happy to answer them. Or you guys can also put the question in the chat if you don't want to speak out loud. Okay, I don't think we have any questions. If you guys happen to have any questions later on, just send us an email, send us a message, and we'll be happy to address it. But without further ado, okay, this is a graph that we always want. Go ahead, John. You can go on the slide.
Yeah, absolutely. This is just the graph that we made with our corporate accountants that illustrates exactly how the investment is handled from Canada to the US and how it's held with the general partners, the shareholders, and so on and so forth, how the properties are being held and how a limited partner operates in the entities. And some of the good things about this graph is that there's no double taxation, there's liability protection, easy of doing business, and has additional asset protection. We're not accountant professionals, but we can get farther into the logistics of this. If you do have any questions, we can always get our lawyers and accountants on a call and go farther if you do have any questions or concerns.
Yeah, and then we're actually planning to do that. We're planning to bring our our accountant into our one of our next webinars coming up. So then there could be questions answered along that, and if anybody has any questions, they can always be referred over to that webinar. Okay, guys, other than that, that is pretty much the end of the webinar. We just wanted to encourage folks that if you want to schedule a call with their team, we are one click away. We specialize again in multifamily properties across the US, and we bring on passive investors that want to invest passively and they don't want to deal with the day-to-day. And this is what we do. We manage the properties, we increase the rent on the properties, we execute on a business plan. This is what we do. So this is you guys can schedule a call with us, or anybody can schedule a call with us, and we'd be happy to share that. And then last but not least, we just want to give you guys a thank you for all those folks that showed up today. We just want to thank you. We want to thank you for your time. We want to thank you for joining us on our webinar. We hope you found the information informative and valuable. As we continue to grow and invest in multifamily real estate in the US, we would like to invite you to join our investors list to be notified of future investment opportunities. By joining our list, you will have access to exclusive investment opportunities and updates on our portfolio. We look forward to working with you and helping you achieve your investment goals. Thank you again for your time and support. And I just wanted to add to that, we do have a podcast that we just launched. We've had about 3 episodes so far. We have some pretty significant players in the syndication space that we've brought on to bring value to folks. So it's called Investing Passively in US Multifamily. Investing Passively in US Multifamily Show. So if you guys want to check that out, by all means. Other than that, anything else you want to add, John, as we wrap it up?
I'm good on my end. Thank you, everyone who showed up, and hope you learned something new.
Thanks, guys. Thanks for everybody for joining us. Take care.